Everything lined up for the hedge trade. Bitcoin just sat there. Wednesday, August 19th, 2026. Today's agenda: the 30-year Treasury yield touched 5.3% on Tuesday. The S&P 500 down less than 1%. Worst corner of the market was not chips. First, the minutes at 2 o'clock Eastern. But why are these numbers moving so hard right now? The 30-year Treasury yield touched 5.33% on Tuesday, its highest level since 2007. Japan's 10-year yield hit a 30-year high, and Germany's its highest since 2011. The reason is not the Federal Reserve. It is supply, and much of that supply comes from artificial intelligence. Investment-grade companies have sold close to $1.5 trillion of bonds this year, 36% more than last year. Alphabet, Amazon, and Meta account for nearly $220 billion of that, which means those three alone have doubled what they issued in all of last year. Bank of America economists estimate corporate and mortgage bond supply has added about 30 basis points to the 10-year yield this year. That happens because every data center bond competes for the same long-dated money that buys treasuries. Why should you care about a corporate bond calendar? Because 30-year mortgage quotes follow that curve within about a week, and the Freddie Mac average already sits at 6.67%. Your retirement fund feels it too. A higher discount rate cuts the present value of profits that arrive years from now, which is why the Nasdaq fell 1.3%, while Micron dropped 7%. Watch for today's 20-year bond auction, 1 hour before the minutes. If demand fails there, 5.5% stops being a ceiling. And it gets worse if you own anything that pays no interest at all. Here is Tuesday's scoreboard. The S&P 500 fell 0.7%, its third straight decline since last week's record. The Nasdaq Composite fell 1.3%, the Dow gave back 0.2%, and the Russell 2000 fell 1.3%. The damage sat in one narrow place. Micron fell about 7%, and the Van Eck Semiconductor Fund fell 4%, while the equal weight S&P 500 edged higher. The average is the gap between two rates that far apart, because the selling was concentrated in chips. The price swings index rose 4% to just under 16, which means traders are a shift in expectations, a discount rate rather than hedging a panic. Gold rose 1.11%, and silver fell 3.5%. Brent crude held above $91 a barrel, and the dollar index barely moved. Bitcoin sat near $64,000. So what does that mixture tell you? It says this was not a broad flight from risk, because that would not leave the Dow nearly flat. Stocks with cash flows far in the future were repriced, and you should expect that pattern to repeat while the long end sits here. Even better assets are getting squeezed by global politics right now. Here is the least obvious true thing from Tuesday. The worst corner of the market was not chips, it was Bitcoin miners that stopped mining. Cypher fell 9% and TeraWulf fell 7%. Hive gave back most of Monday's 11% jump on a $350 million cloud deal. The fund tracking those names fell 6%. None of that came from Bitcoin itself, because the price barely moved. These companies converted power contracts into artificial intelligence data centers. TeraWulf alone holds 839 megawatts under long-term lease. That revenue arrives in 2027 and 2028, which means these are long-duration assets. A yield near 4.7% discounts them like any growth stock, which is why the bond move hit them harder than it hit Bitcoin. If you own a broad crypto or blockchain fund, you already own some of these companies. Separately, Citigroup said it will hold Bitcoin for institutional clients later this year, which puts a $2.8 trillion bank alongside BNY and State Street. One session produced the strongest structural news crypto has had in months, and a 7% drop in the builders. The risk is that the equity market is right, and the custody news is noise. Watch for that gap to close by the end of September. The minutes of the July 28th and 29th meeting land at 2 o'clock Eastern this afternoon. They are sealed until then, which means the vote is all anyone has. The committee held the target range at 3.5 to 3.75%. 3 regional presidents dissented, and every one of them wanted a quarter-point hike. Beth Hammack, Neil Kashkari, and Lori Logan had not voted together like that since 2016. Chair Kevin Warsh has dropped forward company outlook, which means every meeting is live. Traders now expect a September hold, with hike odds near 31%. That is down from roughly 2/3 right after the meeting, because every print since then has come in soft. The shift in expectations was driven by data the committee never saw. Payrolls came in at minus 23,000, consumer prices ran at 3.4%, producer prices were flat and retail sales fell 0.6%. Watch for the head count words rather than the tone, because some and most describe very different committees. Finally, let's turn to first, the minutes at 2 o'clock Eastern. 3 things to watch. First, the minutes at 2 o'clock Eastern. Read the head count words because the gap between some participants and most participants is the gap between 3 hawks and a majority. Second, target, lows, and TJX report before the opening bell. Options pricing implies a move of more than 5% in lows alone. Those 3 tell you whether July's drop in retail sales was noise or the start of something. Third, the Strait of Hormuz. If the vessel count holds in single digits by Friday, the war premium in crude is not coming out. Now the call. I expect the 30-year Treasury yield to still sit above 5.25% when this week closes. That is because the supply calendar does not care what the minutes say, and 30-year inflation-protected paper comes to market on Thursday. Here is what would prove me wrong. A rate-cutting set of minutes, plus a strong long-dated auction, would take the 30-year back under 5.2%. Your mortgage quote and your index fund sit on the other side of that question. Today's market shows a clear split where high yields are crushing both safe assets and crypto simultaneously, while oil prices remain elevated due to global tensions. The 30-year Treasury yield touching 5.33% on Tuesday is the main driver here, revaluing stocks with distant cash flows like Micron down sharply as investors flee risk.